Our next speaker for today is Mike Moore. Mike, warm welcome to you and thanks so much for joining us.
Morning.
Great. So Mike is a portfolio manager at Veritas Asset Management. They manage the Nedgroup Investments Global Equity Fund. So Mike, shall we jump in? I actually wanted to start with performance, please. So I was here at Nedgroup from, since when we appointed Veritas to the mandate all the way back in 2010. And if I think about your return signature over time, you do tend to lag in rising markets, but kind of the current scenario does feel a little bit extreme. Can you please talk us through that?
So over the last 3 months, we've delivered 0.4% returns versus the MSCI World Index at 7.3%. Obviously, that is significantly lagging the index at present. Obviously, our focus is on sort of durable, defensive, high quality companies that typically exhibit sort of lesser cyclicality. You've also had that compound with the narrowness in the market into some areas that are more speculative. And sort of not typically sort of areas that we focus on, and so that narrow cohort of companies that have done well, while we have got some exposure to some of the things around AI, they're more in the kind of the more durable sort of businesses. That's obviously sort of bled into the 1-year performance, where the fund has delivered 3.7% versus the MSCI World Index of 17%, and then over 3 years. We've delivered in absolute terms 14.9% annualized return, whereas the MSCI World Index has delivered 24%, nearly 24% returns over that period, which is very much an anomaly with sort of historical statistics. That 14.9% is versus our CPI plus 6% goal of 9% over that period, but it is still lagging, obviously. Since inception, we've delivered 9.3%, and whilst that is lagging the MSCI World Index at present, that is still ahead of our sort of 8.5% CPI plus 6% target. And what I think is important to note here is we really do have a real return focus. So we're looking at sort of investing in an absolute basis. And so we're looking for durable, defensive, high-quality businesses with a focus and evaluation discipline. And so we think that will produce strong risk-adjusted returns going forward, and we're very confident in that the portfolio will deliver that over time.
Thanks, Mike. If we can just focus on the 1-year numbers specifically now, please. I just want to kind of go through a bit of an attribution analysis. We actually had some of your colleagues in our offices recently, and we were talking about kind of the impact of healthcare, tech, and Diageo specifically. I mean, do you mind elaborating on that, please?
Yeah, absolutely. So I think in terms of the healthcare positioning, that's been sort of half of the underperformance, and I would say there that healthcare has seen pressures. I would argue that over kind of the last 3 months, we've actually started to see some green shoots in some of the end markets there in terms of life sciences and tools where we do have exposure. And so we do think actually some of those positives are actually coming through now. Much in the same way that we saw with aerospace and defense a few years ago, and also technology. And so we've made some adjustments to the portfolio and sort of increased positions in our highest conviction calls in healthcare. And I think that started to benefit sort of more broadly as well. So I think it's been a difficult period for the healthcare sector, because they've obviously seen a cycle that they wouldn't typically have seen as sort of ex-COVID. But we do think actually that there are some sort of positive signs in terms of recovery there going forward. I think in terms of the IT exposure, now obviously that has been a drag around about 3.7%. But you have to also remember that we have actually technology exposure more broadly outside of kind of the IT area. And so, for example, Alphabet, Google is in communication services, Amazon is in consumer discretionary, and those are offsets. And also, we do think in some areas of information technology there is a lot of exuberance as well, and so that also sort of explains some of the reason for the underperformance there. But we still have a reasonable position in information technology overall, but we're focused on the more durable sort of defensive subscription type businesses. The final, I'd say, detractor is in terms of Diageo. And that is a business whereby, again, it's had sort of ex-COVID sort of issues with demand and in terms of its inventories. We do think that is now actually starting to sort of bottom out. They have a new interim CEO in Nick Janjani, who we have met, and we do think he's a very credible and capable operator. And so we do think a lot of the long-term tenets of the investment case are still very much there for Diageo. And so we still expect that to come through over time, even if it is taking slightly longer.
Thanks, Mike. You did allude to some of the portfolio activity recently. I just want to turn to that in a bit more detail now. I see London Stock Exchange and Waters, two stocks which you have held previously. They've been out of the portfolio for a bit, and you've just recently bought back in now. Do you mind maybe chatting through some of the top activity in the portfolio?
Yeah, absolutely. Well, I'll start off with the complete sale. So Richemont, which is the kind of the owner of the Cartier jewelry brand, we actually exited there because of several exogenous factors that are going to impact the company. So firstly, they have strong FX movements, and they have transactional impact there. Gold prices obviously have been significant, which obviously impacts them. And then there have been sort of Swiss tariffs in the US that are also sort of impacting. So given that, we felt that actually there were risks around sort of the cost side of the equation for Richemont, and exited the position. Sonic, which is a medical diagnostics sort of lab business, there it had a reasonable return on invested capital, so in the kind of in the low double digits. But when we were looking at the healthcare portfolio, we've actually put that into sort of higher conviction positions. Now, one of the resultant actions there is where we got an opportunity to redeploy capital into Waters. It's a business that we've known in the past. It's in life sciences and tools, has a very strong operational track record, producing high single-digit growth, and we do think that the CEO and management team there are very capable. However, it has generally had an organic growth profile historically, but it has made a recent acquisition actually of another one of our companies, part of their business, their biosciences business in Becton Dickinson. And we actually think there are strong synergies between those two businesses, with a very capable CEO at the head of Waters, with a clear and defined plan. And we met him and went through it all. And so we think there's a really strong opportunity for Waters to deliver value at a very attractive valuation. Another new purchase was London Stock Exchange. I will go into that in a bit more detail subsequently. But again, we felt that there were some concerns around its positioning and threats from AI. And that actually has seen a material decline in the share price and an attractive entry point. And then the other two, Hyatt and Compass. In terms of Hyatt, it is one of the 5 largest franchise hotel companies globally. But it is obviously a beneficiary of leisure travel. But franchise hotels and branded hotels are actually growing in the mix and taking share. And Hyatt is the smallest of these, with the most, we would argue, most potential for market share expansion. And also is turning its business from a kind of owner-operator type business to a much more asset-light type, an asset-light type company. And that will have benefits, return on invested capital, and also free cash flow per share. So we took a position there. And then Compass, which is a global catering company. It's actually got 10% market share of the global of the global market, but it is still a very fragmented market. But it is 2.5 times bigger its next biggest competitor, and so it has scale advantages. And we think actually it can grow in a durable manner, sort of 6 to 7% for the long term, with again excellent management. So we're taking idiosyncratic opportunities as and where they come up.
Thanks, Mike. And you already did allude to the fact that healthcare is quite attractive at the moment. I mean, I would like to go through the portfolio composition now, if you can please elaborate in a bit more detail, because I know that your style is typically to buy great businesses that are high quality before other investors actually recognize the quality and push the price up. So yeah, just please share a bit about that, and perhaps also if you can just touch on the higher cash position, please.
Absolutely. Well, I think in terms of the portfolio breakdown, you can see at the top, we've got Microsoft and Amazon. We've actually reduced the position down in Microsoft somewhat. It was our largest position, still is, but that has reduced. And that's really because of sort of a compression in the IRR after a strong set of results recently. Within that sort of top 10 holding list, obviously United Health has sort of risen. It's obviously faced sort of a challenging period over the last sort of 6 to 9 months, but we've actually sort of added capital into sort of the into that pressure, and that's actually started to sort of show some benefit. So in terms of the highest exposure sort of sectors, we've got industrials, which is 20%, which is consistent with sort of recent periods. Healthcare is obviously a very strong theme in the fund at 19%, and then information technology, although it's 15%, we've got other elements that actually sort of backfill that technology exposure. So consumer discretionary, we've got Amadeus, which is travel software, and Amazon is also in that segment as well. So that position is higher. In terms of the regional exposure, we've got 55% in North America and around 36% in Europe and the UK at present. And in terms of the cash balance, that has gone up and it is higher at 9%. But that should be really seen as potentially sort of being used to fund positions as and when we see them. And so we have had a bit of flux in the portfolio in terms of some of the positions. And so that I think, albeit there is probably a slight upward pressure, that could be deployed at any time as and when we get an opportunity.
Thanks, Mike. The other thing I just want to ask you is, I mean, just with all the hype around AI, you don't really hear many people talking about all the risks inherent in it. And I mean, as we've seen, there's been like so many large capital deployments, there's relatively small revenues today, and then also the circular funding of commitments. I mean, what are your thoughts on that, please?
So I think obviously it's the big topic that a lot of people are focusing on presently, and I would say in terms of how we've looked at it is we understand the long-term AI thematic and the opportunity there, but where we've deployed capital is to look for what we consider to be the most durable businesses with the most sort of the ones with the most recurring in nature. And what you've obviously seen at the kind of the outset is kind of the more picks and shovels of that have done very well. And I think this point about the capital investments is an important one. So if you look at the 2023 of the kind of the largest players in the market, that capital investment's gone from 150 billion to an expected 500 billion over 5 years. And that's a cumulative 2.3 trillion in capex. Now, not all of that is AI, but a significant chunk of it is, and it just gives you a sort of an inkling as to how how much capital is actually being put in here. At the same time, you've got a lot of sort of commitments going forward that again will increase that sort of capital investment. So, for example, OpenAI have announced a single project that would have 10 gigawatts of data center capacity plan. Now, that sounds quite a nebulous term, but that's more peak power demand than the likes of Switzerland and Portugal. So these kind of capital deployments are very significant. Obviously, in the bottom left-hand corner, you can see that the AI-related stocks have seen strong performance, especially since Liberation Day. But this is increasingly being driven by a narrow subset of companies. And so these are kind of AI semiconductor companies like NVIDIA, AI infrastructure companies that are in cooling and power. But we are seeing sort of the classic signs of a capital cycle forming. And the one thing I would also say is that even the industry participants are acknowledging some of these risks. So for example, Sam Altman has recently said, when bubbles happen, smart people get overexcited about a kernel of truth. So it's difficult to say as investors, you haven't been warned that there are risks inherent. I think one thing to really sort of focus on is those capital deployments are big and potentially they're justified. But it's just the quantum of those capital deployments and the revenues that these companies have to sort of generate to fulfill a return on invested capital over time. And here, if you look, AI revenues are still very small today in the context of that capital deployment. So Anthropic and OpenAI are ChatGPT's makers, they're fast growing, but they still have, from sort of public public press reports, 18 billion of annual recurring revenue at present. And so these companies make up the majority of what we would classify as AI native revenues today, so over 80%. And the capex is obviously considerably higher than that today. So we're talking, nearly $500 billion potentially. And so that does pose question marks about what fills in that demand, because that's just revenues. You've got to then generate profits and returns off the back of that. There's also a circularity in the funding and revenue of these companies. So in the bottom left-hand chart, you've got sort of a triangle. The top there is ChatGPT. They have announced a commitment to spend $300 billion on the infrastructure services of Oracle. Now, these infrastructure services that Oracle provide are based on GPUs sold by NVIDIA, and NVIDIA in turn have announced sort of investment in OpenAI of $100 billion that will pay for some of these commitments. So it's very circular, and so we do think there are risks that are mounting here, and this is not the only case. There are other examples as well, and you've got to remember about the ambitions of OpenAI. That 300 billion of spend is, they have to make a return on that. And so they have to have a sort of a multiplier of that. That's just your infrastructure cost. So typically that would be 2 to 3 times higher. So really they've got to be generating maybe $600–900 billion of revenue cumulatively. But today they're generating 4.6 billion in revenues in H1 and burning 2.5 billion of cash. When this deal was announced, Oracle added 250 billion of market cap in the day, and yet this is a completely unfunded commitment in reality. There are things that are coming in like the NVIDIA sort of the kind of the NVIDIA investments and that sort of thing, but it's still a big disparity between the amount of capital going in, the revenues, and then the ultimate returns. And so we do think that we should be cautious around some of these areas and the kind of the exuberance that you're seeing in the market.
Thanks, Mike. I just want to highlight that chart which you showed us of kind of the stock price performance of companies that have benefited from AI and how it just shoots up. But, of course, there are many companies which are impacted negatively by AI, and, surely now they're just a lot less important than they used to be. Can you please talk us through some of those?
Yeah, so I think it's really an interesting contrast between the perceived AI, sort of AI winners, and then the impacted stocks. Now, one of the things I would say in terms of the slide is that these are the share price performance since ChatGPT, and we're not making a comment on the quality of any of these investments individually, but just to illustrate a point. And so, for example, an Accenture, which has a number of employees, offshore headcount in sort of areas such as India that do a lot of those workers do a lot of sort of coding, programming, those sort of things, and these tools can actually make that much more efficient or usurp it entirely. So there are question marks around how that business model changes. You've got companies like Adobe where creative tools for design, you're going to be able to do, well, you are doing image generation of things like ChatGPT and Gemini today. And again, does that change the nature or the competitive moats of that business? Then you've got Chegg, which is educational resources. I saw a study recently in the UK that 88% of students are actually using AI resources or tools to help them with study. So again, there are changes that are happening. And then you have the companies like Wolters Kluwer where they have businesses in legal and in healthcare that again that are repositories for information, but how that changes is also a kind of a key question mark. So there's a narrative being built around the perceived competitive impact to these companies. So data assets, are the assets proprietary? Are there ways that things like AI can actually get round and circumvent some of the proprietary nature of these assets? Research focused companies, is the nature of research changing? Is there more competition? So some of these some companies like OpenAI have got these deep research products. So is that actually going to be a spend that actually gets diverted to some of these different research tools? You have worker dependent businesses that are basically business models that are seat based. So if you've got sort of white collar sort of worker attrition, does that get impacted? You've also got businesses where they're input focused, so time and materials. Whereas it may change that those become much more output based. And then finally, you have things like replacement technologies where actually automation has already happened, but this is kind of the next iteration of that. And you can broadly see it in terms of some of the industry performance since sort of ChatGPT launch in education services, employment services, IT services, and then research and data. What we would say is that actually this is also an area where we can find opportunities, and so look at it from a contrarian perspective. And so whereas there's a lot of exuberance on one side of the market, there's also a lot of business models that can innovate their way out of it, or maybe not as impacted as maybe as expected. And so those are the areas where you can see significant sort of valuation and valuation compression that we're looking to see if there are any opportunities. And so that's something that we continue to do.
Great. Thanks, Mike. That certainly does give us some insight into your thinking and the way you approach companies. On a related note, I just want to circle back to London Stock Exchange. I think that's probably a very good example. If you can please illustrate kind of your thinking around the recent purchase and how it fits in with your approach.
So in terms of London Stock Exchange Group, I think this is probably a perfect example of what we're looking to do. So actually looking at things from a bottom-up perspective, and discerning between the narrative and the reality. And so London Stock Exchange is famous, obviously, for its exchanges business. But today it's got that capital markets business, which is in sort of 22% of the business. Post-trade, where it has 90% global market share of over-the-counter interest rate swaps. And then, it has a FTSE Russell Index business, which is leveraged to nominal asset value growth. That's half the business. But they've actually 6 years ago purchased Refinitiv, which is a data and analytics business. And this is where I think more question marks are being sort of raised on AI. And so this is half the business. And if we take that data and analytics business, that is broadly what are called workflow productivity tools, I guess, and sort of data and feed, so proprietary data sets. And what we've seen is that actually LSE, probably sort of 9 months plus ago, was seen as a kind of an AI beneficiary because of its proprietary data sets. And if you look at the bottom left-hand chart, you can see that's materially unwound in terms of sentiment. And the concerns here that AI disrupts LSE's business because of A, the proprietary data isn't maybe as differentiated as expected, and B, some of the workflow productivity tools could also be usurped. And part of this was driven by Anthropic releasing a product, basically Claude for financial analysis, and it is a relatively low-end product today, but that could usurp some of these businesses like the kind of fact sets, the Bloombergs of this world at the lower end. And what we find is actually the workflow business for LSE, the majority of it is actually in trading, where it's very mission critical, and there's if things go wrong, it's very costly. So it's very, very difficult to disrupt, and a lot of workflows are dependent upon that. Where it is more challenged is potentially in desktop workflow tools, which is, I'd say, the more casual user. But when we look at that, that's really only sort of 5 to 7% of revenues today. And so it's really looking at what's being priced in. And LSE today trades at around, where we deploy capital, trades around 6% free cash flow yield. It's got a highly durable moat in at least what we think 95% of its business. Has strong, revenue growth at, mid to high single digit growth, predictability of earnings and high free cash flow generation, and low double digit EPS growth profile. When we looked at the sum of parts and looked at kind of the downside risks as well, we found that actually the sum of the parts valuation ascribed de minimis value to the desktop workflow tools business. And so we do think there's a significant margin of safety there. I would also add that the desktop workflow business is not necessarily impaired. It could actually be benefited from AI. It's just too early to say. And we do think that the proprietary data is actually going to be enhanced by AI rather than usurped over time, because we actually think the really difficult bit is to get those proprietary insights rather than how you actually pull those together. And so we think that LSE is actually well positioned, but that is not being discounted in the price at all today. And so I think this gives an example of just what we're looking to do. So when we're seeing things that are presenting idiosyncratic opportunities with strong absolute IRRs and defensive sort of predictive earnings profiles, those are the things that you are likely to see us step into, where we can see an asymmetric risk reward.
Thanks very much, Mike. I think it's very clear that the portfolio is a great collection of very high quality businesses with strong prospects. So we really appreciate your insights, and thanks for joining us today.
Thanks very much.
Okay, take care. Bye-bye.
Thanks.